The 2008 financial crisis was a global economic downturn that had a significant impact on the European Union. The crisis, which was caused by the collapse of the housing market in the United States, quickly spread to other parts of the world, including the EU. The crisis led to a severe recession in the EU, with many member states experiencing high unemployment rates, slow economic growth, and an increase in government debt. Despite efforts by the European Union to recover from the 2008 financial crisis, the EU has yet to fully recover. In this video, we will take a closer look at the impact of the 2008 financial crisis on the EU, the EU's recovery efforts, and the reasons for the EU's failure to fully recover. The 2008 financial crisis had a significant impact on the European Union, both economically and politically. Economically, the crisis led to a severe recession in the EU, with many member states experiencing high unemployment rates, slow economic growth, and an increase in government debt. The crisis also led to a sharp decline in consumer spending and business investment, which further exacerbated the economic downturn. Politically, the crisis led to a rise in populist movements and anti-EU sentiment, as well as a loss of trust in EU institutions. The crisis also revealed deep-rooted economic and social disparities among EU member states, which further contributed to the rise of populist movements and anti-EU sentiment. Additionally, the crisis led to a sovereign debt crisis in several EU countries, particularly in southern European countries, which put pressure on the EU to come up with solutions to assist the affected countries. In response to the 2008 financial crisis, the European Union implemented several measures to try and recover from the economic downturn. Some of the key recovery efforts include the European Stability Mechanism, ESM. This is a permanent crisis resolution mechanism that was established in 2012 to provide financial assistance to EU member states in financial difficulty. The ESM can provide member states with loans in exchange for economic reform measures. The European Central Bank, ECB. The ECB is the central bank of the EU and plays a key role in stabilizing the EU economy. During the crisis, the ECB implemented a number of measures, such as cutting interest rates and launching quantitative easing programs, to try and stimulate economic growth. The European Union's Fiscal Compact. This is an agreement among EU member states to implement strict budget rules, which aims to prevent future debt crises. The Fiscal Compact requires countries to reduce their government debt and budget deficits, and to adopt measures to improve competitiveness and growth. Banking Union. EU established the Single Supervisory Mechanism, SSM, and Single Resolution Mechanism, SRM, to increase the stability and resilience of the EU banking sector and to support the EU's economic recovery. While these measures were implemented with the intent to revive the EU economy, they have not been entirely successful in achieving a full recovery, as the EU continues to struggle with high unemployment, slow economic growth, and rising government debt. Despite the EU's efforts to recover from the 2008 financial crisis, the EU has yet to fully recover. There are several reasons for the EU's failure to fully recover, including lack of coordination and unity. EU member states have different economic conditions and priorities, which makes it difficult to implement a unified recovery strategy. Additionally, there is often a lack of political will among member states to make the necessary economic reforms and to coordinate their efforts to revive the EU economy. Failure to address structural issues. The EU has not fully addressed the structural issues in its economy that were exposed by the 2008 financial crisis, such as the lack of competitiveness, productivity, and innovation in certain EU member states. Limited effectiveness of EU recovery efforts. Some of the EU's recovery efforts have been limited in their effectiveness, such as the European Stability Mechanism, ESM, and the European Union's Fiscal Compact, which have not been able to fully solve the problem of government debt and budget deficits in some EU member states. The ongoing COVID-19 pandemic has also added to the EU's economic struggles, as it has led to a sharp decline in economic activity and increased uncertainty, further hindering the EU's recovery efforts. In summary, the EU's failure to fully recover from the 2008 financial crisis is due to a combination of factors, including a lack of coordination and unity among member states, failure to address structural issues, limited effectiveness of recovery efforts, and the ongoing global pandemic. The 2008 financial crisis had a significant impact on the European Union, leading to a severe recession, high unemployment rates, slow economic growth, and an increase in government debt. Despite efforts by the EU to recover from the crisis, the EU has yet to fully recover. In this video, we examine the impact of the 2008 financial crisis on the EU, the EU's recovery efforts, and the reasons for the EU's failure to fully recover. The EU's recovery efforts, such as the European Stability Mechanism, ESM, the European Central Bank, ECB, and the European Union's Fiscal Compact, have not been entirely successful in achieving a full recovery. It's important to note that the recovery process is a long-term one that requires a combination of short-term measures and long-term structural reforms, and it's necessary for EU member states to continue to work together to revive the EU economy.